Today, will mortgage rates go higher? Hello again, I'm Martin North from Digital Finance Analytics. We think mortgage rates for existing borrowers will move higher in the weeks ahead as funding costs continue to rise. In the USA, the 10-year US Treasury bond rate remains well above 3%, and we see the highest effective 30-year mortgage yields in 7 years or so. Here, in Australia, a critical funding benchmark for banks is the bank bill swap rate, or the BBSW. We discussed the BBSW last week in the context of upcoming changes to LIBOR. See our post, The Problem with LIBOR. The RBA argues that the critical difference between BBSW and LIBOR is that there are enough transactions in the local bank bill market each day to calculate a robust benchmark. Australia has an active bank bill market where the major banks issue bills as a regular source of funding, and a wide range of wholesale investors purchase bills as a liquid cash management product. In recent times, this benchmark rate has risen, although the latest charts on the bank bill swap rate shows that rates ease slightly from the peaks reached in April 2018, but we're also now seeing a higher move again in the past week, so the trajectory is still up ahead. And in practice, the gap between the lowest and highest rates for the 3-month series peaked at 32 basis points, but it is now back to 17.5 basis points, still up, and perhaps enough to put pressure on bank margins as a result. And by the way, a basis point is a common unit of measure for interest rates. 1 basis point equals 1/100th of 1%, or 0.01%, so 50 basis points would be 0.5%. On average, around 30% of Australian bank funding is drawn from the capital markets, and this includes significant short-term borrowing, so changes in the BBSW will impact their costs and so profits quite quickly. In the recent results season, several of the banks mentioned the pressure on margins, which the rise in the BBSW represents. For example, Westpac reported net interest margin increased by 11 basis points to 2.16%, reflecting higher spreads on certain mortgage types, including investor lending and loans with interest-only features, and increased deposit spreads. These were partially offset by the bank levy, which was effective from 1 July 2017. But they also warned that margins would be impacted by higher funding costs ahead. NAB said their overall net interest margin was down 1 basis point. A rise of 5 basis points, reflecting repricing and lower funding costs, was offset by the impact of the bank levy and housing competition and product mix changes. And CBA reported a flat net interest margin, in stark contrast to Westpac, and expenses were higher due to provisions for regulatory and compliance. ANZ Group net interest margin fell 5 basis points from the second half of 17, and this despite net interest margins being up in Australia by 5 basis points and New Zealand up 6 basis points. Now, back in March, Suncorp hiked variable owner-occupied and principal interest rates by 5 basis points, and variable investor principal interest rates by 8 basis points, and variable interest-only rates by 12 basis points. And in addition, Suncorp's variable small business rates rose 15 basis points, and their access equity line of credit product rose by 25 basis points. The bank's CEO David Carter said at the time the decision to increase rates was based on increasing costs of funding as well as meeting the costs associated with regulatory change. The outlook for US interest rates factored in the decision as well. As a result, he said, we have seen the key base costs of funding, being the 3-month bank bill swap rate, rise approximately 20 basis points. This increase results in higher interest costs to our wholesale funding, as well as our retail funding portfolio, such as term deposits. And now today, the non-major lender MyState Bank has made what they called a difficult decision to increase interest rates for variable residential investment loans by 9 basis points for both new and existing loans effective from the 29th of May 2018. They put the decision down to changing dynamics in the financial services industry. In their accompanying statement, the bank said that the MyState Group reviews interest rates in response to a range of factors. These include regulatory requirements, current market conditions, costs of funding related to wholesale and retail deposits, and investments to upgrade MyState's competitive position in the mortgage lending and deposit markets. MyState Bank's fixed-rate home loans are unchanged, but any variable residential investment loan customers who are affected will be advised of any changes in repayments within the next 2 weeks. Significantly, we are beginning to see a spate of repricing on what's called the back book, or mortgages already held by the bank, while we see some selective discounting from players to attract certain types of new borrowers. The truth is, with the backcloth of higher funding costs, we expect more lenders to move to reprice their back books as last year's hikes to investment loans play out. While some have claimed that the currently running Royal Commission may cramp the bank's style, we expect more rate hikes ahead despite this. And of course, even small rises will translate into more financial pain for many households, as we will show when we release our next mortgage stress report at the end of the month. We are currently tracking more than 963,000 households in mortgage stress, which equates to 30.1% of owner-occupied borrowing households in Australia. And in addition, more than 21,600 of these are in severe stress, up from last month. We continue to see the number of households rising, and the quantum is now economically significant. And things will get more severe, especially as household debts continue to climb to new record levels. If you like what you've seen here today, please like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.